Welcome to Tradespoon in Yellow Tunnel. My name is Vlad Karpel. I'm CEO and founder of Tradespoon in Yellow Tunnel. And today we're going to have a live trading room open to trade stock and option using our technology. Before we begin, we just want to say thank you. Again, Happy New Year to everybody. If this is your first live event of this year, best wishes to you and your family. Happy and healthy New Year. This is my brief bio. I was Executive Vice President, Head of Technology at Options Express from its inception through 2007. Started Tradespoon in 2012. I want to take this opportunity to say thank you to all the subscribers. Because of you, I'm able to do what I enjoy professionally, managing and trading my own money. I've been doing it for over 15 years. Mentoring and teaching subscribers how to trade stock and options. And finally, I have a master's degree in computer science, specializing in statistics and artificial intelligence. Disclosures are very important. Please read them. Trading stock and options involve risk, not suitable for everyone. You must be aware of the risk and be willing to accept it in order to invest in current market conditions. I'm not a financial advisor. I'm not registered with FINRA nor SEC. I'm showing you what I do in my own account based on my own risk tolerance level for general education information purposes only. Please consult your financial advisor prior to making any trading decisions. John, what are the brand of headphones? Hold on. So the question was about the headphones I'm using. They're pretty good. It's for video games. Senior. S-E-E-R. E-E-R. Phones. Sennheiser. Broadband had Sennheiser. No, I don't think that's it. On the headphones says Senior headphones, but doesn't look like. Let's see. Sorry. Pro gaming headphones. Exactly, wire 7 sound sweater. I have to look at my account, but it doesn't look like you can easily find them. I don't think it's a Logitech. It's Pro Grade Mic, Pro Gaming. Let's see, maybe this is it. No, it's not. Okay, sorry. Now I'll look it up. Send me an email so I don't forget. I'll look it up and I'll let you know. Thank you, John. Thank you, John. Video games, yes. All right, perfect. So, okay, I kind of diverted a little bit. Again, pillars of successful trading. Let's go over that. One, disciplined trading involves, one is the economy of control, right? You're reading all these prognosis and market outlook, and there are ranges. You know, market is going to be up this year, market is going to be down this year. Targets, you know, ranges anywhere from 300 or 3,000 to 4,000 in S&P. So pretty wide range. There's a lot of unknowns, you know, in the market. One thing that's I think is fairly certain that we will have again volatile market, and perhaps even more volatile than last year. So where you have this several 20% rallies, 20% sell or 30% sell-offs. So the economy of control is a very important concept. The idea that you can only control your own thoughts and actions, right? And you can really predict what the PMI numbers will be at the 10 a.m. Eastern, or how the market will react to the Fed notes at 2 p.m. Eastern. But the only thing you can control going into these events, you know that they will create volatility. Next week, we're going to have a CPI number, probably even more volatility. It's again, reviewing your cash position. I propose, if you're bullish on the market, I think a lot of people are bullish on the market, calling for positive end of the year returns. Maybe it's time, to lower your cash to 30%, right? If you think that we've reached the bottom, right? If you think we have October is the low, and this is not just, kind of out of the blue left field, opinion. These are very notable, very experienced money managers that, that come out and basically said, we have set the lows, right? So if you believe that we have set the lows, and I did the survey, I think last week, a lot of, most people said that we have set the lows, that we're not making new lows the first 6 months. If that's your opinion, I think 30% of your portfolio should be in cash. I would still not buy on the margin. I would have still strong cash position in case market is volatile and we either going to reach the lows or we'll break the lows, but you want to have a large cash position. Probably the other half of the people that surveyed or have an opinion think that October low will not hold, including myself. I don't think the October low will hold, for many reasons I've explained before. So as long as the Fed doesn't pivot, right, don't fight the Fed. That's one rule that I think is basically set in stone, right? Usually you cannot find an exception, so very few exceptions out there. But as long as Fed doesn't pivot and continues to either raise rates or hold the rates at the, whatever the 4.5% terminal rate or 5% terminal rate, then market potentially can make new lows. So for that reason, I would propose to have 50% of your portfolio in cash. So depending on the view on the market, 30 or 50%. Personally, I'm 50% in cash, probably more at this point. But that would be the rule. One of the rules that you don't want to break, right? You don't want your cash to drop anywhere below 30%, at least the first 6 months of the year. Once, we reach October, November, usually bullish time of the year, Christmas rally, end of the year rallies. Okay, great. Maybe you can reduce that to 30% or less. But until then, I think there's still a lot of unknowns. Russia-Ukraine war, inflation, China, COVID, and many, many other reasons. The second one is portfolio drawdown, right? We have control over how many positions we have. I propose to have 4 positions and maximum risk of 2.5% account value position. Again, very unpopular opinion, right? Because you turn on TV and and even the most, bearish traders, that I would consider bearish traders, they're buying Tesla, right? They think Tesla at 100 is a great buy. They buy in Rivian, right? One of the most bearish professional traders are buying Rivian. So, which is fine, right? It all depends. The question is, yes, you can be bullish on Tesla and Rivian. The question, what is your time horizon, right? If your time horizon is, 2 to 3 years, then maybe you can start again, dollar cost average, right? I wouldn't buy Rivian with the assumption that we have made the lows. I wouldn't buy Tesla with the assumption that we made the lows. But you can basically say nobody knows. We might or might not hold the lows. For that reason, since I don't know, I'm going to put small percentage of my position into that trade. But it doesn't. Every day you're going to have these signals: Rivian, Tesla, Ford, J.P. Morgan. I don't know, utilities, Bitcoin. My proposal is that, again, 4 positions, 2.5% of account value, because one thing that I am fairly confident is that we are going to have multiple rallies and sell-offs year, just like last year, right? Last year we had 10 to 20% drop, 15% rally, 20, 25% drop, 20% rally, 30% drop, 20% rally. So most likely we're going to have multiple of these, on average 15 to 20% rallies and sell-offs till the end of the year, and potentially for the rest of the, even into the next year. So for that specific reason, you do not want to be over leveraged, right? Because if you assume we have reached the bottom and we have not, and you have more than 4 positions and your stop loss is more than 2.5%, all it takes is one of these sell-offs or rallies if you're on the wrong side of the trade and you're down more than 10%, right, 20, 30%, very hard to recover. I was reading a report and someone said, you have to be risk averse in this environment. You have to realize that if Tesla drops 50%, right? If Tesla dropped 50%, for you to recover, it has to go up 100%, right? If you were bullish on Tesla, right? A lot of people thought that this level will hold, right? So Tesla dropped by 50%, right? So it basically, to recover, it has to rise by 100%. So you have to do a lot more work just to break even, right? If you ended up on the wrong side of the trade. So for that reason, I encourage you to be risk averse, at least now. And if you are still bullish, use dollar cost average, right? And hold your positions to 4. There's a lot of noise out there. You can, even in Tradespoon or Yellow Tunnel, we have more than 4 signals, but I encourage you to be selective, right? And always look at your portfolio beta. Make sure your portfolio is not overextended. All right. Meanwhile, what is the most important developments? It's yield, right? You look at the Switzerland, France, CPI data from Europe coming out today, better than expected. Negative months over months in France, negative months over month CPI, and big drop. I don't know. I think 0.5% from 7 point or from 6.4 to 5.9, something along those lines. But more than anticipated drop in the inflation data, and you can see at the start of the year, significant drop in the 10-year yield, right? Until T continues to rally, right? We're talking about this downtrend and then bouncing off the downtrend. So it looks like inflation is either plateauing and dropping. It's still a very high inflation. 5, 6, 7% inflation is not a normal inflation. It's going to probably take more than just 1 or 2 months to bring it down to this 2, 3% acceptable level. But the bottom line, the consensus, I haven't seen almost any report that says this is not going to be the year of bonds, right? Or whether it's treasury, corporate bonds, municipal bonds. This is what you will get more decent returns. So if your horizon 6 to 12 months, I think buying municipal bonds, buying treasuries, buying corporate bonds, LQD, TLT is something that makes sense. So that's one of the most main developments. Dollar, again, trading in the range. We had a pretty significant rally yesterday. It's pulling, dollars pulling back today. That also will dictate, where the Tesla and Rivian is going to go, right? It's not the earnings of Rivian or the Rivian that under delivered the number of cars, or Tesla, under delivered it's the interest rate that will drive the prices of Tesla and Rivian. So far lower yield, right? Treasury continues to rally, and you have divergence, right? QQQ is up 0.5%, right? QQ is up 0.5%, but not as much as TLT, right? So we still have money floating into Treasury and into equity, but equity QQQ is kind of stuck in this range, going through consolidation, right? In the past 3 weeks, week 1, 2, 3, it's not going anywhere, and basically retesting the lows, right? Retesting 52-week lows. Again, the question is, Apple drop below its support line, right? Continue to make new lows below 52-week low. on its way to retest 117 level, right? 50% retracement. So the question is, will QQQ be able to hold their levels if Apple is kind of underperforming? Tesla, it continues to make new lows, and Microsoft and Google will follow, right? We have a downgrade in Microsoft, so Microsoft is down 4%. The answer is most likely no, right? Most likely it's just a matter of time for technology to break down. Obviously, if we are getting better than inflationary data, and Fed might pause, you could have a rally, right? You could have a rally in the market, and 52-week low will hold. But I still think it's going to be only temporary, right? So for that reason, again, 4 positions, 2.5%, concentrate on things that you can have a control over. Personally, I'm bearish, right? Personally, I'm bearish in the market. I think January, February is going to be volatile to the downside, and I would not be surprised that by middle of February or by end of January we are retesting 350 level, right? Because we're kind of going through this consolidation for the 3 weeks, right? And then usually there's a continuation. Right? But it all depends on CPI data, right? If the CPI data next week in the United States is similar to France or Switzerland, then inflation will subside, right? And then the following week Fed comes out, and they might say, you know what, we have now 3 data points showing that CPI's data drops, and we're gonna pause, right? We're gonna pause, or maybe even pivot sooner than everybody expects. If that's the message next week's, market will rally, right? And you will have a significant rally. How much? Hard to predict. Maybe 410, maybe even 420, right? It's conceivable. So it's very important for the bears to have a reasonable stop loss, right? So let's say 380. Let's say you want to short the market at 380. You see previous overhead resistance is around 415. You don't think it's going to break. So, okay, it's 30 points, right? So you have 30 points to the downside if you short the market. And then you have positive 30 points. Let's say you think that we will retest the low, right? So you're looking for 30 points gain, 30 points loss. That's your kind of, if you're trading with few weeks horizon or few months horizon, that's the setup, right? That would be the setup. So if you short, then you have to decide how much are you willing to invest based on your own opinion. So I'm bearish in the market. How much money am I willing to invest, right? And maybe I want to have 4 positions. Maybe I want to, have, maybe I think banks will sell off. Maybe I think energy will continue to sell off, and cetera, et cetera. So, okay. So on the 10,000 average account is $10,000, right? In Tradespoon and Yellow Tunnel. So I propose on those 4 trades, you don't risk more than $250. Right? You don't risk more than $250. Again, with the idea that if I'm wrong, let's say I'm bearish, right? And most of my positions right now are bearish. If we do have a drop in CPI and Fed does say at least we're going to pause and wait and see what happens, right? And then you have this 30-point rally in the market, I want to make sure that I'm not down more than $250. How many shares can I buy? If the market is going to move up 30 points, well, 8 shares, right? So then I can buy 8 shares, right? If I'm buying S&P puts, right, 360 level or 370, again, my stop loss is if the option drops more than $250. So this is the most important calculation. I would not be surprised if the market gets to 410 level, right? I would not be surprised. I would not be surprised if the market drops to 350. I think my core scenario is that the market drops first, right? Because I don't think Fed will want to pivot, and the Fed doesn't want to, because the problem is the Fed does pivot and inflation does come back, which I think Michael Burry, the big short today, came out, and in his investment letter to his audience, he basically said that we will have a repeat of 70s and 80s where inflation rise, then it drops, and then inflation rises again. He didn't give a time frame. Is it 2 years from now, 3 years from now? But recession is not just going to disappear by end of this year, basically. So you're going to have more and more people going into that camp, and I think Fed is in that camp. Fed is terrified of, the worst case scenario that inflation drops, like in France, right? France basically ECB starts lowering interest rate, and then interest rates, and then inflation comes back. All it's going to be is just kind of a prolong, short term, yes, market will rally, but longer term market will sell off even more. So the idea is to kind of just, fight the inflation to its, making sure that it's longer term contained. So whether Fed will or will not pivot, my opinion that it's just a matter of time to break this level. I mean, we can break it January, February. If not, we'll break it in June, July, but eventually it will be broken. All right. And again, you can kind of look at the oil, right? This is a different price action than last year, right? Last year was the energy. It was just start of the year, and energy was just relentlessly going higher. We did have pretty large pullbacks, 1, 2, 3. This year energy started, on the downside, right? You can see crude oil. I mean, it's a way to retest the lows around 70, which is both energy and gas are trading at the levels lower than the start of the war, right? The start of the war. All right. Any questions? Good morning, Bernard. How are you? All right. John Biersch, thank you. Fred, gold and silver. Gold and silver, yes. I think it's going to be a year of silver and gold. The question is the timing. I personally think it's overdone, and it's too much, too fast. And the main reason, the main reason is the dollar, right? If market is going to break through, if you think that the market will break through the 52-week low, the only way it will do it if dollar will actually rallies, right? We can see a dollar is not going anywhere, right? Dollar is not going anywhere for, it's kind of in the past, I don't know, 1, 2, 3, 4, 5, 6 weeks, months and a half. It's just kind of building the bottom. And again, the question is there a continuation, right? Or is there a rebound, right? So continuation, that's soft landing. So if you believe in soft landing, if you believe we have reached the lows, then yes, this is the time to buy gold and silver, and you can see gold rallies, right? Because dollar is going to continue and just slide down, right? And the scenario would be, which is totally possible scenario, is that CPI is better than expected, market rallies, and then JP comes out and say, listen, 3 data points, that's statistically significant enough that at least we should pause and perhaps start pivoting, even by the end of this year. If the JP says something like this, then yes, dollar will drop, at least short term, for the next couple of months. Market will rally for the next couple of months. Then you will, and I mean, soft landing, again, if Michael Burry is right, then, we're not going to have a soft landing, or it is, we're just going to postpone the inevitable, right? We're going to postpone inevitable comeback of the inflation. So if you believe in hard landing, that we will not make 52-week low, this is kind of my opinion, at least opinion I'm following, and the research that I'm following is that dollar has not the bottom, right? This is kind of this huge A, right? You can call it this big A wave, right? Almost in linear fashion that got everybody by surprise, right? Dollar is at 20-year high. You have strong wave B, right? Strong wave B, and then C is coming, right? ABC pattern, right? The wave C is coming. So if that's the case, then it's a little bit too early to buy silver, right? Because if the dollar rallies to at least retest the levels or potentially even break 114 level, the silver will sell off precipitously, right? So if that's the case, and again, you can say, Vlad, nobody knows. Maybe we have set 52-week low, maybe we have not. So same thing. If you want to buy silver instead of Rivian, fine. Just don't buy silver, Rivian, and and Tesla all at the same time. Keep 4 positions, $250 on a $10,000 portfolio is the maximum loss. You can start nibbling in silver, because I think dollar will peak this year. And I do agree with that consensus, that at some point we will reach the bottom this year, right? And like we will look at 2008, we looked at 2001, 2003, silver and gold will start recovering before, the equity market. So if I actually have to think about, do I buy silver, do I buy Rivian or Tesla, probably buy silver first, right? Because I think it will bottom before, but it will bottom when dollar will reach its maximum. All right. So Fred, personally, I'm not buying silver, to answer your question. So SMH outpacing QQQ this morning. Yes, I think one of the main reasons is Microsoft, right? Microsoft was downgraded. And you can see right now we are trading in the market where any hint of negative news, right? If Microsoft was downgraded, in 2021, it would have probably rallied 5%, right? Now, the price was lowered. I think it was to 250, and then Microsoft dropped 4%. So I think that would be the pattern of this year. But big rally in China, yes, China is bullish, right? This is another good. A lot of people are bullish on China this year. We do have this continuation, similar to silver, right? One of the main reasons China is rallying, not because they are reopening and not, their demand is still down, still have, kind of mind-boggling number of COVID cases. So that story is not over. So I think short-term it's overbought on this news. Will China, yes, before you buy Tesla, you probably want to buy China. So I do agree with that, similar with silver. But I think, again, it's a dollar story. The reason China is up because dollar is down, right? And if dollar is going to rally, the China is going to have a hard time, dealing with the debt. Angelique is back. Angelique, welcome back. Raymond, you open up a ticket. I mean, give it 24 hours. Usually we do respond within 24 hours, and let me know tomorrow if nobody responds to you. But, please provide your email, phone number, and let them research. But tomorrow, if nobody responds to you, please let me know, and I will research. Fred, thank you. Gold and silver idea. Okay. So yes. So one of the themes this year will be China, right? It will be silver. And one of the things will be crude oil, right? Kind of a crude oil continue to drop. Meanwhile, let's see, where are we? So 10-year drop, I would watch, again, this line in the sand, 3.5%. Right? Again, I think it's just a matter of break that. That's one of the main developments. So 3.5 interest rate, TLT is up, and let's see, value stocks are up 0.5%. Wheat prices continue to drop. QQQ is basically flat. Semis rally, right? Semis have rallied. Spiders slightly up, 40 basis points. All right, let's review the positions. Any questions so far? No. Okay, so let's review the position. All right. Okay, so 117 put. So I did buy. So I did Iron Condor, right? Earnings season kind of slow right now. There's not a lot of earnings this week or last. Earnings will pick up next week, right? The earnings season starts. So one of the favorite strategy for this year, I think, is against assuming market is going, even the people who think that we have reached 52-week low, right? Even the even the market gurus that think that the market has reached the low, they still think that the market is trading sideways. We're not going to have multi-year rally. We're not gonna make new highs this year, right? They're basically proposing that we're gonna have positive returns, but not reaching 52-week high. So one of the most common strategies is selling out of the money premium. So on XLK, I sold 127.5 call, and I did sell 121.5 put, kind of lagging into it. When market was overbought, I sold 127.5 call. When market dropped, 121.5. So that's the trade, right? If you look at XLK, right, it reached 120. So the overhead resistance is 127, support is 121. So if you think we're not going to reach these levels, then that's what you trade. We do have in 12 minutes we have PMI numbers, right? ISM manufacturing number. So that can spark volatility, right? We already had them from France, from Europe. It's still, they were better than expected, but still below 50%. So still contraction in manufacturing number. So I don't know how much, it all depends on how big is the jump move. But that can definitely spark the volatility. Sorry, ISM manufacturing number. So that can definitely spark volatility. And then you have, jump openings could do the same. And then we have FOMC meeting, that can also spark volatility depending if there are any notes on long-term view on the inflation and any indication how long Fed is going to stay hawkish or quantitative tightening. So if you want to avoid that risk, right? If you want to avoid that risk, then you have to actually I just check. I did get a SMS message on XLK 117 put. Okay. But if you want to avoid this, then you would have to close this iron candle, right? If you think market is, with the CPI data, like last time, trade went against me because I opened the trade going into the, I think, Fed decision, right? And you know that when Fed, when Jerome Powell speaks, you will have large movements. We do have also unemployment numbers on Friday, which can also spark volatility. I personally don't think it's going to be a significant move. It could be. So for now, XLK short put, right? XLK 121 put is trading at about, you can maybe close it at 70 cents. And short call is trading at about 27 cents. So you can close it for half the profit. I personally going to keep it. We'll see how and manage it if the trade going to go against me. All right. So I'll put an order for 121.5 put to close it at 10 cents. Buy to close, one limit, 10 cents. So the risk to the downside, I have $4, $4.50, right? So I have $4.50 of risk, $450, and I collected 85 cents and 60 cents, $1.40 minus hedges. So I'm risking 30% return, right? 30% return on the risk I'm taking. And or about 1% on the value of the ETF. Any questions on the XLK trade? Okay, that trade didn't go through. Let me just try to put that order again. Okay. Okay, so for now I have 121.5 put to close at 10 cents. And then I have 127.5 call to close at 10 cents. Both expires on Friday. The risk is, again, we have unemployment numbers on Friday, then today we have meeting minutes from the last Fed meeting. Any questions on XLK trade? Bob, yes, if you don't like the wide bid and ask spread, I don't like it either. Trade QQQ, right? I mean, it is a short-term trading. You do need to have at least $25,000. So if you have $25,000 or more, I encourage you to do the same trade on QQQ. QQQ and XLK are very highly correlated. If you have less than $10,000, 5,000, 10,000, and you want to do something similar, I would encourage you to do XLK. Again, for the same reason, for the reason that I basically say, you know, if let's say market sells off 2%, 2% of a $120 stock, you're down $250. 2% of QQQ, $300 stock, you're down $600, right? So if you have $25,000 and you're down $600, okay, you are close to your 2.5%. But on a $5,000 account, if you're down $600, that's 10% drop. You know, that's then you're violated one of the rules. So it has to do with account value, right? Which is very important. And I want to make sure that everyone who does this trade understand, right? One of the rules, I actually updated my trading plan, is a strike price selection, right? You can't just because something is liquid, it doesn't mean you can trade it based on your account value. So if you're doing these credit put spreads and credit call spreads, especially wide credit put spreads and wide credit call spreads, then strike price selection is important. I would encourage you, you know, under $10,000, not to trade stock over $100 or ETFs. Desi is back. So yes, and it's credit call spread, credit put spreads. All right. Let's see what else. Let's review other positions. Again, market is kind of trading in this narrow range. Not much is going on, right? For almost a month, we've been trading in this range. Obviously, I think, you know, sooner, probably as early as next week or even this week, we will break out of this range, right? So we have week 1, week 2, week 3 going nowhere. You know, we're either going to retrace back to the trend line or we're going to retest 52-week low, right? Those are the only two directions. You know, I favor to the downside, but I do recognize that upside is also possible. What else? What else? What else? So IWM March. So the goal right now is to start, especially on most of my positions are bearish. On the pullback, I want to start closing March position and meanwhile opening up June positions. Because again, I think there are two core scenarios in this market, right, for this year, right? It's the break of this 52-week low, right? But the question becomes when, right? It's either first quarter or potentially third quarter, right? It's either going to happen in Q1, right? The break, it's either Q1, right? And if we don't break in Q1, right? If we don't, let's say here, If we don't break in Q1, that means, again, Fed pivot or something along those lines. We might continue going higher, and then we will probably only break it. September, October is usually bearish time of the year. So the way I'm thinking about these levels, it's either Q1 or Q3. I favor Q1, but as I said many times, timing the market is very difficult. So I do recognize, it might not happen in Q1. It might happen in Q3. So for that reason, I favor closing March positions in case, one market pulls back, in case, it's not Q1, and then opening June position, or going even September position, because I think it's going to happen, May or June. So that's my thought process. So for that reason, I'm still bearish IWM. Do have a small NOC position. NOC is kind of not going. Let's look at IWM. IWM, same thing. It's kind of going through consolidation phase, not going anywhere. NOC, same thing. I mean, not same thing. I mean, it's at 52-week high, but also going through kind of a top building. It's either going to have a continuation and rally on the earnings, right? Because the war in Ukraine is still ravaging, unfortunately. Probably gonna, at least for the first 6 months, still the war is, on, and U.S. and Europe approved their budget. They're spending a lot more money on their military. One of the beneficiary, in theory, should be Northrop Grumman. So still in that position. QQQ, bearish, right? I have 280, 290 credit call spread, bearish. I have 250 put, bearish, and then I have 270, 280 put spread. So QQQ is the most bearish position I have. I do have SH. If you're not comfortable trading QQQ put spread or credit call spread, SH, right? You can continue to buy SH to hedge your portfolio. And bearish on XLF. I have 35 put on XLF. We're, bank's going to start announcing earnings in the next, I think next week, or week and a half from now. And I closed again. So this example, I closed March call spread. Now I rolled them into June. So again, selling 35, 38 call spread, XLF. I think banks are going to have hard time in this, making this money in the environment, especially if interest rates are going to drop, right? If interest rates continue to drop, then banks are going to have a hard time. They did pull back, right? We have a kind of double top, pull back, rebounded. I think next move is to the downside. I don't think this level will be broken to the upside. So that's XLF, and I think we talked about XLK. Okay, and the XLK is the only short-term iron condor I have to kind of continue to do, premium harvesting. Any questions? Right. Meanwhile, let's look at what's interesting. We do have a nice rally. Materials kind of not going anywhere in the past 3 weeks. Home builders, same thing, not going anywhere. Metals and miners pull back. Germany is up, right, on better than expected CPI data, right, but still not breaking out, kind of trading at this overhead resistance. China, continuation, right, of its rally, up 3%. Energy kind of, still bearish price pattern in energy, on the weaker, on demand, drop in global demand. Dollar pull back today. Talked about TLT. REITs are oversold, so they are rebounding today. Russell 2000 is up 1%. QQQ is slightly higher. Spiders is up 60 basis points. QQ up 40 basis points. Semis are up 2%. Amazon is down. Microsoft is down. So Micron, so a lot of movements. And all right, so let's see what else is interesting. Talked about oil is down. So materials have a short-term rally. Yeah, so good. Micro's the biggest, right? Problem is Apple, Microsoft, Google, and Amazon, right? All the and Tesla, all the mega cap technologies are under a lot of pressure. JP Morgan is up, Wells Fargo is up, going to the earnings. Airlines are up. That's about it. All right, any questions? John, I opened XLF call spread in June, so credit call spread. John, bearish for June, I agree. Okay, thank you, John. Any other questions? Larissa, Angelique, Bernard, Bob, Brenda, Carol, Claude, Clayton, David, Desi, Ed, Fred, Guy, Han, Jason, John, Krishna, Cool, Lalit, Mario, Michael, Mitchell, Patrick, Peter, Phil, Raymond, Renata, Ron, Thomas, Todd, Mark, Tom, Val, Vamsidar, Victor. Any questions? Okay. So 10:04, we did have. So we did have job openings in ISM. Let's see, has anything been updated? Okay, so looks like ISM was in, anticipated 48 and a half, 40, not a big surprise. Uh, Openings, Jolt numbers are same as last time. Market reaction, let's see, how did market react to this? 10-year yield did rebound slightly after that. Let's look at 15-minute chart. Right, so we have a rise in yield, right? Basically, probably because of job openings, right? There's still tight labor market, so that would be the move, and then QQQ is down and spiders are down. So kind of familiar story, right? Stubbornly high unemployment, low unemployment numbers, a lot of job openings. That means that service PMI will continue to stay elevated, and 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 the market pull back. All right, any questions? So let's watch the spiders. Looks like a pretty sharp pullback back. I mean, in the range, right? We've been trading 386, 387, kind of in the middle of this range. And I would watch the mega cap, right? Because that's Achilles heel, right? That's the weakness of the market. Is your Apple, Google, Microsoft, Amazon. Right, it's 10:07 in Miami, 9:07 in Chicago. Let me know if you guys have any questions. Any other premium harvesting ideas beyond what you have discussed already? I mean, the most popular is, basically dividend. You take dividend-paying stocks, right? Like, I don't know, Coke, right? Like Coca-Cola or healthcare, right? XLV, right? I still think XLV is going to outperform the rest of the sector this year, right? So XLV or any components of XLV, I mean, pays 1.5%, right? How much is like Top Holdings XLV? Top Holdings XLV. Top Holdings XLV. Let's see if they are which one pay dividend. Right, Johnson and Johnson UNH. Johnson and Johnson UNH. Let's look. Let's look at Johnson. Probably get somebody. Johnson and Johnson. 2.5%, right? So you take someone like Johnson, somebody like Johnson, not somebody, but a stock like Johnson and Johnson. You get 2.5% dividend rate, right? I mean, you want to do better than TLT. TLT gives you 4% a year. This gives you 2.5% a year. So I still think Treasury, TLT, and selling calls against TLT is one idea, right? You can buy TLT and sell calls against TLT, right? Or call spreads against TLT, or you can take Johnson and Johnson or XLV if you don't want to take the risk of individual stocks, and you sell calls against it, right? You have a stock, sell calls. The problem was not the problem, but healthcare is overbought, and it's already pulled back, and it might have another leg down, especially if the market reaches 52-week low. So the problem was the healthcare stocks or consumer staples for that matter, right? Same thing could be consumer staples, is that they they can still drop, 15 to 20%. They're probably not going to drop 30 or 40% like technology, but they can drop 15%. So, if you have a large portfolio, you can do dollar cost average, maybe buy 100 shares, buy another 100 shares. But if it drops 10%, you're not going to lose more than 2.5% of your account. Then I think it's fine. If it drops 10% and you're going to be down more than 2.5%, then I would not do that strategy. I think TLT is the better strategy. Just buy TLT, sell calls against it. Right? Just buy TLT and sell calls against it. What would be the natural guess story about the natural guess story? The bottom line is demand, right? Everybody thought because of the Russia-Ukraine war, Europe will freeze to death. And today there was the first shipment of liquefied gas from United States to Europe, right? So now they're shipping liquefied gas. The temperatures are above, I think in the United States, 20 degrees above the average of what they anticipated. So very warm weather, right? Chicago is like 50 degrees, so unusual warm climate for this time of the year throughout the United States and in Europe. And obviously the demand for gas is dropping, right? And global recession, right? There is a consensus that at least 30 to 40% of global economies will at least hit mild recession. That means you need less plastic, you need less, heating, and less, you just demand for gas is dropping. So that's the story behind natural gas. Another one is again, and I think the more important one again is this idea that we are entering a bear market. no, we're already in bear market, but the bear market is going to be, not right. There's two bear markets, right? There's a bear market with the recession and bear market without recession. The bear market with recession, usually spiders drop, somewhere around 20-30%, right? So spiders did drop 20%, right? With the assumption that there is no recession, right? Spiders is down 27%, which is average drawdown for a bear market without the recession. If you have recession, right, 2001, 2008, okay, now spiders drop, average 40%, right? Average 40%. So, it's reasonable to assume that, we do have a mild recession, that the market will drop 40%, all, top to bottom, and demand for oil and gas will drop significantly, right? And usually oil is the last, commodities are the last bull market across all asset classes, right? They're the last man standing. That's why last year the oil was up 30%. I don't think the oil will be up 30% this year. Most likely it will be a significant down year for the oil, at least the first 6 months. So that's UNG and oil. Victor, yeah, silver, gold miners all sound similar. I think we're a little bit too late. Right, we're a little bit too late. I think the best of this rally is behind us. I mean, just like FX side can continue. It's a dollar play. I think I think gold miners will revisit the lows. It might not break the lows. It will revisit the lows. But I think it's too early to be bullish on gold miners. Elite on the third tab, XLK. So this is elite on XLK. Yeah. So the question was to show XLK trade again. So again, I'm looking at the range, right? I'm looking at XLK, 1 hour chart, because this is I only have a couple of days till expiration. You can clearly see that XLK support is around 121.4, overhead resistance is 128, right? So that's the trade, and it's actually turning negative as we speak. So this is a better relationship, right? What I think is going to be the rest, right? The money will flow into the bond market, and they will float away from the equity market. All right. And spiders is flat. Okay. You start due to volatility. Todd, question about FOMC meeting notes. I mean, usually, it's just this is from previous meeting, so usually there's no news. I was reading some notes that there might be something in the notes that indicates how long the Fed will stay hawkish, and that could spark volatility, right? Because right now market is very, it's very vulnerable, right? Microsoft, some, analysts, I don't even know how credible this analyst decided to downgrade Microsoft, and Microsoft dropped 5%. That's just not normal behavior, right? What does it mean? People are anxious, people are nervous, right? Where's VIX, right? VIX is, VIX is complacent, right? No positions are not hedged. Nobody's buying Microsoft puts or Tesla puts because VIX is at 22. So any negative news, and you can have these exaggerated effects. Plus, first week of January is still, most people are in Miami, or on vacation, and they don't really not really participating, right? The volume will start picking up next week. So I don't anticipate a lot of volatility, but would I be surprised if we do have a lot of volatility? No, I would not be surprised. I think right now market is extremely nervous. Thank you, Todd. Right, Connecticut 60 degrees, right? If Connecticut is 60 degrees, then Angelique needs her gas bills are going to be significantly lower. Mario, I am in Miami now. Yes, visiting my parents-in-law, staying with my parents-in-law, sleeping in the dining room. I love it. It's great. Uh, in the family room, yes, family room. Victor, gold, right? So gold miners, silver. To me, they're all the same. For now, I think if you want to use dollar cost average, right, you want to take your trade, whatever you usually buy, 100 shares, let's say, of silver, buy 30 shares right now, right? If usually you buy 100, buy 30. If you usually buy 30, buy 10. Right, this way, if I'm wrong, then at least you have some upside. But if I'm right, you'll have an opportunity to buy it at a lower cost basis. TLT is 262, Bob. Thank you. Fred, TLT cover calls on TLT. Okay, thank you. Cash secure put. Okay, Fred. It's all about position management and number of positions. It's all at the end of the day, we all have a lot of ideas. I can give you 100 ideas right now where you can put your money, but bottom line, you have to be very selective, right? Warren Buffett said you have to be extreme. I forgot the phrase, but you only have so many bullets in your gun, right? 7 bullets or 9 bullets, I don't know how many, right? So you can't really shoot more than how many bullets you have, right? Unfortunately, with the stock market and leverage, you have unlimited number of bullets, so you have to be very frugal, right? You have to be very frugal. You have to be very selective, right? You have to think multiple times before you act, right? And be very selective in terms of what you decide to buy. UTO2 pays 3.6. Thank you, Bob. Thank you, Maria. ARK is still not participating. Yeah, ARK is not going to be participating anytime soon. Well, I shouldn't say that. Again, the question is ARK is not participating. I think ARK is not participating because Fed has not pivoted, right? I was reading the notes again. It says number one rule in trading: don't fight the fight. Don't fight the Fed. It's very simple. So ARK will not participate until Fed, if CPI data is, soft landing, CPI data is better than expected, Fed comes out and basically say, you know what? Yes, there is a risk that inflation will come back, but they know about economy a lot more than I do, and they, for whatever reason, they said, you know what? We want to pivot, or at least we're going to pause, and we're going to pivot sooner than later, right? Something along those lines. If they do say this, ARK can jump to 50 very quickly, right? Is this a very likely event? What's the confidence level on that event? I don't know. I would put 10%, maybe 20%. I'm 10 to 20% confident that Fed will pause in February, and will indicate that before the end of the year they will start lowering interest rate. I think, is it possible? Yes. How confident that will happen? 20%. But if it does, ARK will jump to 50. If Russia and Ukraine reach ceasefire tomorrow, ARK will probably be at $50. Right? So, it is possible. But many firms seems to be adjusting price targets. Right. So analysts are behind the ball, right? Analysts are still thinking that we are in bull market, and this is just a regular mean reversion, right? So now they have to start adjusting their slower. So that's why this earnings is going to be extremely important season, right? And most likely all the revisions down that we're seeing in Tesla, Microsoft, Apple, CRM, Salesforce letting go 10% of their workforce, not because they're printing money, but because the demand is, nobody is renewing their licenses. Not nobody, but a lot less companies are willing to renew their Salesforce licenses, so they're letting go 10% of their workforce. So everyone is going to start revising their earnings down, and that's not factored into the current price multiple, right? Current price multiple, I think on S&P the projection is I think what's it, $200, right? $200 multiple of 15, so 3,300, right? So a lot of firms basically projecting the low to be around 300, and their reasoning for that is that the earnings of S&P 500 companies will be between 180 and 200, and it's reasonable to give a multiple of 15. So they are putting 300. In some of the bear market that coupled with recession, you see multiple of 12, right? So they're saying worst case scenario, it's 240, 260. So that's we just have to wait and see if these adjustments are correct, or these projections are correct. Bob, IEP moves well. Thank you, Bob. Thank you. See you PM. Today is Wednesday. Scott will do the closing bell. We do have a YouTube channel. So all of you guys are on YouTube channel. Is anybody there? But we're still broadcasting on YouTube, right? Let's see, But okay, so we do have live broadcasts every Monday and Wednesday. Please join us. Click on subscribe button, and if any of this content is beneficial to you, they're most likely beneficial to other subscribers. So I would greatly appreciate if you do click on subscribe and share these videos on social media. If you're part of any traders community, whether it's a blog or forum or Instagram, please post these videos there. Thank you, Angelique. Thank you, Fred. Appreciate your kind feedback. Phil, thank you. All right, guys. Thank you, everybody. Thanks a lot. Have a great day. Closing bell, Scott. I'll see you tomorrow morning. We do have on Yellow Tunnels subscribers and Tradespoon subscribers. Everybody, please join me tomorrow at 12 p.m. Central. We're gonna, right now I'm trading and I'm talking and I get distracted easily. But tomorrow I'm not trading at 12 o'clock Central, right? 1 p.m. Eastern. We're gonna just go over again the strategy for the next year. Very important to kind of have that, worst case scenario, best case scenario, course scenario, as you're heading into the, at least first 6 months. And I hope to see you there. Thank you very much and have a great day. Desi, bye. Todd, thank you.